On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Wow, what a night and what a start to the week, team. I actually had another piece written and recorded to share with you this week, but we'll put that to one side and save it for later because what we saw overnight last night in the US absolutely warrants talking about. Now, after slumping close to 19% in the wake of the Liberation Day announcements that came in early April, the US share market has now come roaring back to life over these last few weeks. A 90-day pause on tariffs for most countries a week after those initial proposals spurred the recovery, the start of it at least, but the biggest news came on Monday this week, yesterday in the United States. After 2 days of discussions over the weekend, the US and China also agreed to a 90-day ceasefire on the tariff front. The combined US tariff rate on Chinese imports will fall to 30%, which is made up of the baseline 10% tariff that all countries are facing, as well as that 20% fentanyl-related tariff on Chinese goods. Now that's still high, but 30% is a lot lower than 145%, which is where the proposed US tariffs on China had spiraled to before the weekend's negotiations. China will do the same, reducing its levy on US imports to 10% from an equally crazy 125% this time last week. China also agreed to suspend the non-tariff retaliatory measures that it had implemented over the past 6 weeks, including export controls on rare earths. This was all a much bigger announcement than markets were expecting, and it substantially diminishes the risk of a full-blown trade war. It's very good news. As is the case with the rest of the world, the tariffs have been paused rather than cancelled, but we've still bought ourselves another 90 days, and one would hope that the dialogue between the US and China will continue, and that we'll see a further ratcheting down of the tensions. It was notable that China did bring a Deputy Minister of Public Safety to the negotiating table to discuss the fentanyl-related issues. Now that's important because it offers hope for further reductions, and a removal of that fentanyl-related tariff would bring China back to just 10%. So on Monday, overnight last night, the S&P 500 rose sharply in response to this news, and the index has now rebounded 17.2% from the lows of 5 weeks ago. That sees it just 5% down from the all-time high that we saw in February, and pretty much flat on a year-to-date basis. The US dollar has also recouped some of its losses, while gold prices have softened about 6% over the past week as risk aversion has reduced. From where we were at just a few short weeks ago, this is some turnaround, and we've now got 2 separate deadlines to keep an eye on as the 90-day reprieves expire. One in July for most countries, and then another one in August for China specifically. Now, many people thought China would end up getting the roughest end of the stick from the Trump administration, but maybe that isn't the case. And with that in mind, I think it'll be really fascinating to see what this could mean for Europe, because we haven't heard much at all on the deal-making front between the US and Europe. However, the US policy position does seem to have galvanised leaders across the Atlantic, even if that's happened by accident. We've seen a big shift in European defence policy, in spending and in procurement, and all of these things will be very positive for the European bloc in the years ahead. When you consider that alongside China's increased desire to rebalance towards consumption in the wake of these tariffs, you'd almost suggest that Trump's actions this year have been a positive driver of progress. Go figure. Closer to home, these developments should be very good for New Zealand as well as Australia. Neither country was in the immediate firing line when it came to US tariffs, but the indirect effects of a Chinese slowdown were a much bigger risk to the outlook. The local NZX 50 index here in New Zealand is up 7% so far in May, which sees it on track for its biggest monthly gain in more than 5 years. More broadly, markets aren't completely out of the woods, although this is a significant de-escalation. It sharply reduces the risks of a global recession while confirming that this entire process is still a negotiation. Investors who remained calm, didn't panic, and didn't overreact earlier in the piece will be very glad that they did. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.